So chapter 26 is buying options and treasury bills. How the T-bill / option strategy operates. The most one can lose is 10%, less the interest earned on the fixed income portion of the portfolio throughout the life of the purchased options. So you want to space out the commitments to option purchases so that their overall risk in a single year is kept down to around 10%. So an example of this would be an investor might decide to put 2.5% of his money into 3-month option purchases. Therefore, in any 1 year, he would be risking 10%. At the time, he would earn around 6% from the interest generated on the fixed income securities that make up the remaining 90% of his assets. This would keep his risk down to around 4.6% per year. When interest rates are extremely low, such as T-bills, there is no interest earned component. In cases as such, you might want to consider investments with slightly more risk than T-bills for 90% of the assets that are not invested in long options such as AAA corporate bonds or similar debts. The idea here is that the interest earning portion is safe and the option buying portion is risky. Therefore, you would not want to invest in risky bonds such as junk bonds. Overall, this strategy greatly reduces risk with the potential of making above average profits. Since 10% of the money is invested in options, leverage is increased. Therefore, it is possible to double or triple earnings in a short time under favorable market conditions. But if the stock falls a great deal, the bond will not follow since the yield will provide a floor. The T-bill option strategy is simple to operate. Although one does have to work every time new options are purchased, and periodic adjustments are always needed to keep the risk level the same, the criteria for the options to buy is summarized below. Assume that each underlying stock can advance or decline in accordance with its volatility over a fixed period. Estimate the call prices after the advance or put prices after the decline. And rank all potential purchases by the highest reward opportunity. Using the criteria above will usually generate a list of at or slightly out of the money options. It is also important to note that this style of option purchase ranking ignores the outlook for the underlying stock. Keeping the risk level equal. The second function that the strategist must perform in this T-bill option strategy is to keep the risk level approximately equal at all times. So in this example, you see that an investor starts the strategy with $90,000 in T-bills and $10,000 in option purchases. After some time has passed, the option purchase may have worked out, and perhaps he now has $90,000 in T-bills plus $30,000 worth of options plus interest from the T-bills. Obviously, he no longer has 90% of his money in fixed securities and 10% in purchase options. The ratio is now 75% in T-bills and 25% in purchase options. This is too risky a ratio, and the strategist must consequently sell some of his options and buy T-bills with the proceeds. Since his total assets are $120,000 currently, he must sell out $18,000 of options to bring his option investment down from the current $30,000 to a figure of about $12,000 or 10% of his total assets. If one fails to adhere to this readjustment of his funds after profits are made, he may eventually lose those profits, since options can lose a great percentage of their worth in a short period of time. The investor is always running the risk that the option portion of his investment may be nearly wiped out. If he has kept all his profits in the option portion of his strategy, he is constantly risking nearly all of his accumulated profits, and that is not wise. So the individual can blend the option selection process and the adjustment for the T-bill option ratios to fit their individual portfolio. For example, the larger portfolio might be diverse into options with different holding periods, whereas a small investor should concentrate on longer holding periods with adjusting less often. The It should be noted that this strategy is adaptable to small sums of money as long as the 10% that is going to be put in option purchases allows one to be able to participate in a reasonable manner. Next, we're going to take a look at annualized risk. Annualized risk of a portfolio is equal to the percentage of portfolio times 360 divided by the holding period. Annualized risk for a 30-day option is 1,200%, for a 90-day option it's 400%, and for a 180-day option it is 200%. So if you look at the right, we have an example. Suppose that a very large investor or pool of investors has $1 million committed to this T-bill option strategy. Further, suppose that half of 1% of the money is to be committed to 30-day option purchases with the idea of reinvesting it every 30 days. Similarly, half of 1% is to be placed in 90-day and 1% in 180 days. So as you can see below from the formula, we get a calculated annualized risk of 10%. With $1 million of assets, this means that $5,000 would be committed to a 30-day period, $5,000 to a 90-day, and $10,000 to a 180-day holding period. This money would be reinvested in a similar way at the end of each holding period. Next, we take a look at risk adjustment. Adjusting the ratio to constantly reflect 10% of risk must be addressed at the end of each holding period. So in this example, at the end of 30 days, the value of the entire portfolio, including potential option profits and losses and interest earned, was down to $990,000. Then only half of 1% of that amount should be invested in the next 30 days, so $4,950. By first computing the annualized risk and balancing it through a predetermined percentage of commitments at the end of each holding period of various lengths, and then readjusting the actual dollar commitment at the end of each holding period, the risk reward will be kept to close levels described earlier. The truly small investor has several disadvantages for this. So, for example, it's extremely difficult to keep the risk level down to 10% annually with only $5,000. For example, 5% of the money invested every 180 days is only $250 in each investment period. Since the option selection process that is described will tend to select at or slightly out of the money calls, many of these will cost more than 2.5 points for one option. The investor might decide to raise his risk level slightly, although the risk level should never exceed 20% annually, no matter how small the actual dollar investment. To exceed this risk level would completely defeat the purpose of the fixed income / option purchase strategy. Obviously, this small investor cannot buy T-bills for his total investable assets or below the minimum $10,000 purchase level. He might consider utilizing one of the money market funds. Clearly, an investor of this small magnitude is operating at a double disadvantage. His small dollar commitment to option purchases may preclude him from buying some of the more attractive items, and his fixed income portion will be earning a smaller portion of interest rate than that of a larger investor who is in T-bills or some other form of relatively risk-free interest-bearing security. Consequently, the small investor should carefully consider his financial capability and willingness to adhere strictly to the criteria of this strategy before actually committing his dollars. Avoiding excessive risk. Do not try to become fancy with the income-bearing portions of your assets. Some investors believe T-bills are too tame, so they use GNMA, corporate bonds, convertible bonds, or municipal bonds for the fixed portion of income. Although these could yield slightly higher return, they are less liquid and have greater risk than short-term T-bills. Some investors also consider placing the funds in places such as high-yield stock or covered call writing. Although considered a conservative investment, there is much more speculation involved in comparison to T-bills. It is important to remember that the profit potential in this strategy is represented by the option purchases. If you attempt to generate much higher yields on the fixed income portion of your investment, you might find yourself taking on greater risk on the portion of money that is intended for no risk at all. So let's summarize everything we just talked about. The true advantages of this strategy lies in the fact that it has a predetermined risk and does not have a limit to potential profits. Many theorists actually claim that this is the best strategy to use if the options are underpriced when they are purchased. Although a simple strategy to employ, the strategist must not be deluded into thinking that it is so simple that it does not take any work. For example, the concept of annualized risk management are very important to this strategy. This strategy is suitable for the investors who both have the time and the discipline to operate it correctly.